Good afternoon, everyone. How are we all today? Hope you're all okay. To the participants that are here, if you're watching this as a recording, greetings to you as well. I hope the trading's gone very, very well. Big market moves today on the back of some dollar weakness. So what we're going to do today, guys, is we're going to talk about some breakout trading. For those of you who have never attended one of my sessions before, I'm Jack. I'm head of trader development at Tradimo, and basically I've been trading 7 years professionally, institutionally. I still trade more longer term stuff now. So, I've pretty much traded every asset class there is. So if you have any questions about specific asset classes, please feel free to ask me at any point. As I said, in today's coaching, we're going to be focusing on breakout trading and the concepts and some very simple methods that we can employ. And then in subsequent coachings, we'll look at some more advanced strategies for those breakouts. But before we begin, as always, I do need to start with a risk disclaimer. So spread bet in FX and CFD trading carry a high level of risk to your capital and can result in losses that may exceed the initial deposit. Trading of these products may not be suitable for everyone, so please ensure that you understand all of the risks associated with trading. The information and comments provided herein under no circumstance are to be considered an offer of solicitation to invest, and all information provided is believed accurate at the time of production. As well as this, guys, nothing herein should be construed as investment advice, and information provided within this room is the personal opinion of me, that's Jack, the moderator, and not Tradimo or FX Street. This content, therefore, does not constitute financial, investment, or tax advice. Tradimo and FX Street accepts no liability for the content of or comments made during this session. So, guys, now that's out of the way, we're looking at breakouts today. So, how many of you guys actually trade breakouts in your trading career so far? Milan, what about you? AB, any of you guys traded with a breakout? So ForexGal, how do you like to trade your breakouts? Do you like to use aggressive methods, getting in early? Do you like to use conservatives? Maybe you can tell me the two types of trading breakout that they are. Because breakouts are a very, very simple thing to trade, but to get them right, it obviously requires a little bit of tweaking and a little bit of experience. And there are two types of breakouts. Does anyone know what those two types of breakouts are called? So ForexGal likes to use a break of a 20 EMA, exponential moving average with stochastics for confirmation. I'm more along the lines of using things like just very simple support resistance. I do like to use RSI to look, or even stochastics for divergence. Volume is the big thing, guys. We'll be talking about that. And obviously, it's important that you have a trend bias. Now, in terms of the two types, you are right. They are the types of entry, though, Milan. What we're actually looking for is we're looking for continuation and reversal breakouts. Now, the two types of breakouts that are in the market do differ. Obviously, we have the continuation breakouts, and that basically usually takes place when we're looking for either a trend to form or for a trend to potential reverse, as we can see here. Now, for me, the simplest ones to trade are the trade continuation ones, and they're the ones that I actually learn with. They're the ones I would advocate that beginners maybe just bear in mind when they're having a look, because the trend is your friend, as I say. It's very easy to be able to identify a trend in the market. For example, if we have a little look at the dollar yen today, guys, and in terms of the two types, they're actually continuation and reversal. And the most commonly used ones by sort of beginner and intermediate traders are these continuation breakouts. And the reason the continuation breakouts are so good or important to a lot of traders and a lot easier to trade is because you already have an established trend. We had just come to the euro. And if you look in the chart, obviously, we can see we've entered into a trend. And now a lot of people will be looking for some sort of continuation of this move and looking for a break potentially through the high. If we look at sort of the longer term trend in the likes of cable, and for that we will just delete some of these lines, you can see, we've been in a big trend, we pull back, we then have a breakout, we move back, and okay, we do form a bigger range, but generally speaking, you will get some form of continuation, and they are generally a lot more easily traded. So they're the ones that I favor. Reversal breakouts are a lot harder, because you are going against the market, guys. Now, in terms of what is sort of the first thing we consider when we're trading the breakout, guys, are the entries. Now, Milan has already said that there are aggressive and conservative types of entry. How many of you guys have heard of the aggressive and conservative types of entry, and how many of you actually use a particular method? There are actually three. There is the ultra-conservative method, which is to do with sort of trend initiation. Maybe FX Boyke, Lauren, or one of the guys who are obviously breakout traders. Maybe you could actually sort of enlighten us a little bit. What about you, Adam? Forex gal, Milan. What sort of entry method do you like to use when you're trading? Are you a conservative? Are you an aggressive breakout trader? So FX Boyke likes to retest. Milan likes the conservative. Yeah, I'm more of sort of an aggressive trader. You know, I've been trading for sort of 7-8 years now professionally, and I prefer the aggressive method. So, you know, there are sort of three types. Now, the aggressive method basically requires a lot of sort of conviction that a trade is going to continue, and generally the aggressive method will of entry will really take place as soon as the trend breaks. Now, generally speaking, I look for the trend to be broken by sort of a variable number. So if I'm trading on a 5-minute chart, I like to see the actual trend line itself be broken by at least 3 to 5 pips. Now, the reason I do that is I like to try and optimize entry. Now, it doesn't always work. So one of the ways you can sort of factor in if you are going to trade aggressively and try and preempt the move is by adding sort of half of your position on the entry, and then the other half here on the open of the next candle once we've broken out. Okay, but the problem with this is you do need to monitor other factors. For example, things like looking at move and average direction, things like parabolic SAR to look at a direction or potential sort of strength of a trend in a market. Things like the accelerator oscillator are also something that you can use when you are trading with the aggressive method. Well, this is the thing. You have to just sort of look at volume, look at sort of the way the market is trading, and it is a more intuitive way of trading breakouts, the aggressive method. So it's not something that you know, beginner or even intermediate traders should do, because, you know, what is to say that actually, you know, the breakout that we see, and again, let's just remove some of these lines. You will have to excuse me, this was all clear, unfortunately, obviously, with the issue we had with power. The lines have come back from the profile. So there's nothing to say that when you enter into a breakout that it isn't going to be a false breakout. But what you can do is very, very much monitor other factors. You know, monitor the RSI. You want to see a nice steep move up. You can look at the accelerator oscillator. You can look at volume. You want to see higher volume, and you can also use things, you know, such as your MACD. You can use things such as your stochastics. Again, you know, most of these indicators will give you an indication if a trend is going to continue. For example, on the parabolic side, if you're trading on a daily and you see a breakout occur on the daily, you can very, very quickly, you know, nip down to a 30-minute chart and just look to see if the trend is confirmed. But again, very, very advanced. You know, the most commonly used methods are actually the ones that you guys use, conservative and the ultra conservative methods. Now, the conservative method for me is very, very simple. I will sort of enter using scaling in, because how often, you know, you put a trade on and it doesn't quite retest the level after a breakout, will depend on sort of the market you're trading, but it happens a lot. You know, how many of you guys have ever sort of waited for a retest of a level and after a breakout and it's not actually got quite back to that level that you were trading out? You do need a volume indicator. The one in MT4 is not a true representation of the whole market, Dalesh, but it is good enough. You know, I've been testing it for at least 2 or 3 years, and it seems to be okay for just giving you the volume spikes that you see. Volume should be increasing on a breakout. So, you know, how many of you guys have been caught in trades like this before? I know for a fact that I've been caught many a time where I've looked for a conservative entry. I've been, you know, resting an offer in the market maybe here, and the market's never got quite up to that level. So what I will generally do is I will look for a breakout to occur, obviously look for that pullback. And if we just pop to a chart now and have a little look at an example of a breakout where we sort of break through a resistance level here. Okay. And we'll just drop that down, you know, rather than just waiting for the retest, which, you know, is obviously optimal. To ensure that I actually have some of the trade on, I will place it just above the level. And generally, you know, it's to do with the nature of markets, support and resistance not always being at the same price. You know, we know that, you know, we have support and resistance zones. So it's very, very important that I enter into the trade. And even if it's just 25%, the 25% difference that you put on can make a big difference to your P&L if that breakout ensues. And it's not going to make a massive difference to your P&L if, you are resting it just a little bit further on. Well, we'll talk about methods for false breakouts in a second. We're just talking about the entry methods at the moment, Mike. So don't worry too much. We'll be talking about those shortly, some ways for identifying the fake outs. Price action, obviously, is the easy one, as are things like divergence and volume. We'll discuss those in a second. As well as this, guys, how many of you have heard of the ultra-conservative method? Now, this requires trend initiation. Okay, so basically this is something that is generally used in a market that isn't trending. Because we talk about continuation, we talk about reversal, but when a market is actually ranging, okay, like we can see, we have a little bit of a downtrend, but generally the market is in a very big range here. Okay, when a trend actually begins to develop, okay, there are no guarantees that that trend's not just going to form a new high to the range. Okay, there's no guarantees. If a market's been ranging for a long time, like we can see in this example here with our resistance and our support level. Okay, there's no guarantee that the market is going to enter into a trend. Quite often than not, you'll form a new high, a new support high, and you may have a range within a range, but generally you will, potentially just move your support or resistance zone a little bit further. Okay, for example, in this example, we get a breakout of a nice resistance zone and we break back in and we now form a range. Now, obviously, there is a range within a range there, which we look to draw. So we're now trading within this range. And the ultra conservative method is slightly different because what you actually do is you wait for a true break of the range. And instead of trying to enter either on a retest or if you're going to enter aggressively, so let's pop a blue line, instead of trying to enter here, you actually ignore the entry method and you're looking for the trend to initiate so that you can get on the next continuation pattern. And what you would do is you would just wait for the trade to consolidate, and then it is on the next breakout of the consolidation pattern, and here we can see that we have a nice horizontal consolidation pattern that you would actually look to enter. So in this case, we would look to enter around a retest of the level. For me, it would maybe be a little bit above the retest of the level, and then obviously you're looking for that trend to continue, which in this case it obviously doesn't. Now, the advantage of that is generally it does mean you will be trading within a trending market, and that is generally the easiest way to trade breakouts. Consolidation patterns are the easiest way to go. Any time frame's good, but you have to reflect FX Boyke on the amount of time you have to wait for that breakout to confirm. That's one of the things you need to bear in mind. On a monthly candle, you have to wait till the end of the month to confirm the breakout, because even on the last day of trading, it can retrace back. So with the ultra conservative method, you can see we break down. Now, using the standard method, we would enter into the trade here, conservative. Using the aggressive, we may have entered here and sort of here. With the ultra conservative, we're in a range, we break that range. We're now looking for a trend to develop. So we're looking for a consolidation, and we're generally looking for horizontal support and resistance. We're looking for flags, we're looking for pennants, anything that indicates, that this is a tight consolidation pattern. And these are always highlighted by very small candles on the way up, like a slow grind, guys, rather than a big move back. We have a big insen there. Generally, if you get a big Yosen, can tell you that we're actually going to be in the midst of a false breakout, whereas you want to see these blue candles just grind up, okay, an N shape. Think of it as an N shape. Now, when that trend breaks again, okay, this is when you would look to obviously enter on a retest of the original level. And you can see in the euro here, what happens is we break. You could open on the enter on the open, or if you are conservative, obviously look to enter on a retest, and then you're looking for that trend to continue. Okay, so any questions so far, guys? Because we're going to move on now to things like avoiding false breakouts, and then we're going to look at a few other things, a few techniques that we can use, an actual couple of breakout strategies that we can actually use. So, any questions? Okay, fine. Let's continue then, guys. So, basically speaking, okay, the simple strategy for trading breakouts is something that we've already used. How many of you identify a support or resistance level, wait for that level to break, and then you look to enter the trade either on a retest or on the open of the next candle? I would imagine that most of you do that. Now, but Now, when it comes to identifying the support and resistance, one of the ways that you can actually ensure that you're not entering into a false breakout is to look for what I call clusters, okay? And there have to be, in a support level, at least 3 of these clusters. And what I mean by these clusters are, we're not just looking at 3 points where the market has sort of rejected or had a false breakout like we see here. There are actually more than one test of the level. So we can see here that we've actually tested the level 1, 2, 3, false breakout, 4, 5, 6, 7, and then if you include the actual entire support zone, probably about 15 times. Okay, and these clusters, for the simple strategy, the simplest, easiest strategy to trade breakouts, are very, very good. Think about us knocking on a wall, okay, with a hammer. We knock on the wall, we take a chip. We knock on the wall a few more times, that chip gets turned into a bigger hole. We knock on the wall a 3rd time, that chip then turns into a big, big hole, and we break through that hole. Okay, and we knock the wall down. Okay, so for clusters, the simple strategy, the way I use is I'm looking for 3 clusters, not 3 points. I'm looking for 3 clusters. Okay, and generally those clusters need to see a move up away from a support level to the second one. We need to see a nice move away. And at the same time, you know, you can use things like average true range to see how far away that should be. Generally, I like to see at least a 1 or 2 times move away from the average true range before we hit the second cluster. Then, you know, 2 times the ATR, and then we hit the cluster again. And then I know after 3 times from the 3rd point on, I'm happy to trade that breakout. And the idea is these are self-fulfilling prophecies, guys. The more someone looks at a level, the more, you know, it becomes a level. The more that I see a level, the more you see a level. You know, everyone will eventually see that level if it's big enough. And so the breakout should be bigger. Another way to filter sort of levels, guys, is by using support turned resistance. Okay, so if we look on the chart now, guys, and we actually have a little look at what's happening with this euro. Okay, we can see there's been a pretty big breakout. But I like to have a little look at these levels and check to see, you know, if these levels have acted as a resistance or a support in the past. And to do that, you know, you may need to use a little bit of multiple time frame analysis. Obviously, because of the levels we're trading in the euro, it makes it very, very hard. But if we just pop back, okay, we can see already that there's a little bit of a level here that we actually break down from. Does become a very, very good level. So this area of the chart, we can see that we break down, and we see that this level is a little bit of a resistance. Okay, it then comes back to being a support. And there are at least 3 points here, guys, where we see this level acts as sort of a support zone. And then eventually, obviously, we do retest, but we do break out from there. Okay, so it's very, very important. You know, another example here, we can see sort of this area counts as 1 cluster. It has been a support level, but it hasn't had 3 clusters. So I wouldn't have traded this as a breakout, guys. Can you see? You know, we have 1, sort of 1 as a support. Is it a resistance 3 times? Well, no, technically speaking, I'd say this is a cluster. I'd like to see sort of 3 clusters. So I would have liked to have seen another retest here, like to have seen another retest. And then eventually when we break, we move through. You know, if we move the area up, we can see again, there are 2 clusters here, and it's just more secure, guys. We have a support level. It hasn't hit the 3 cluster rule, but we have 1 cluster, we have 2 clusters, and then on the 3rd, we actually do break out. So generally, that's one way that we can filter, guys. Look for clusters of tests. It generally will indicate that a market is going to potentially move. This is the simple strategy. You know, very, very easy. Once we break the support level, we look to enter. Stop loss always goes, you know, either above the level or above the high of the resistance. Some of the other methods, though, that I use, I prefer to use things like continuations. Okay, so how many of you guys have used a continuation trade before? Now, it looks quite complicated, but it's a very, very simple one. Any of you heard of this one? And it is more of a short-term strategy, but basically what we're looking for is we're looking for a resistance level. So we can see that we have a resistance level here, nice resistance zone on the chart. And basically we're looking for this level to break, which it does on this nice big blue candle here. Okay. Now, using the continuation method, what we're looking for is we're looking for a close where the candle closes at least on its 50% from open to the high or open to the low on a break lower. So we can see here, we open, we move through our resistance level marked in black, and then what happens is we pull back to the 50% level. Okay, and as long as it's 50, a 38.2, a 23.6, we're not interested, but we do need to close above that 50% level. Okay, and we need to close above the actual breakout level itself. Okay, on the next candle, pop a Fibonacci onto the candle before. Okay, so we pop a Fibonacci onto this level, and we're looking basically for retracement levels to enter. Now, we're quite lucky in this one. We enter on the 50%, but generally speaking, if we had closed a little bit higher, and let's find an example on the chart of this, shall we? So if we just pop to Euro, and I do apologize, guys, my charts have been messed up by that power cut. Here we go. We have one here. Okay, we break out from this level here. Okay, it's a resistance level, and this candle closes. We pop a Fibonacci onto the chart of this candle, and you can see that we've opened around the 23.6. So when it comes to trading the continuation, have we closed above the 50%? Yes, we have. Okay, good. Have we closed above the level? Yes, we have. So what do? We enter some of the position on the open. This will be part one of the position. I'll mark it up in green. Part two of the position will be plonked on the chart at the 38.2% retracement. And then part three of the position, as long as we are sort of around that trend line, we can place it on either the 50% or on this resistance level, looking for the retest. And the idea is, guys, we're not looking for a long breakout. We are looking for price to test the high. Okay, and generally what we will do is we will look at this next candle to see whether or not we hold the breakout. And one method of determining whether or not, you know, we continue is we should, after a big Yo-Sen candle, after a big bullish candle like that and a break of a resistance, we should continue on the next candle, and we should, you know, at least close above the high. We should have a very small tail. There should not really be a should really not be, you know, a big seller's tail or sort of any responsive selling up here. And what we're looking for is, as long as we close above the high, generally we can hold the trade, because we've confirmed a breakout, but with a second candle also confirms the momentum of the breakout. Okay, and generally what I will do is, if we'd entered into this trade here on the open of the candle, you know, if it is within your risk reward remit, generally you can actually look to take out some of your profit around the high of the candle. You know, look to see what we do around that high, because quite often you will see, you know, we break the high or the low of the candle and then we reject. And if we do close within the breakout candle, there is a chance that we're either going to consolidate for a while, or we're going to break back below our support level that we can see here on the chart, guys. So in this example, we can see recently on the 4 hour, it is actually today, we've broken the level. We've opened on the retracement. We haven't got down to the 38.2% or the 50%. So that's a bit of a shame, because, you know, we are resting a bid, and a bid. But we have probably got, you know, a certain percentage of our trade on. And then that trade continued. We close through. And we're happy that we're now in a breakout trade. Okay. If it closes below, if this closes below the 50% or obviously the breakout level, I generally don't enter into the trade. You know, potentially if we do open bang on a resistance level like this, and, you know, the 61% is above the breakout level, then you might consider entering. But again, you lower your risk parameters. I'll generally trade, you know, half as much risk on something like that. Generally the 50%. The other thing to bear in mind is when we do break out, okay, it's about having the pullback before we break the high, because a lot of times, guys, you know, candles will just be broken by a pip or two and we come back in and we form a rejection. So generally you want to see an open, a pullback, and a move higher. If we opened, we just moved higher and we close below that candle, fair enough. But as soon as we break this high, generally speaking on a breakout, I will pull the remainder of my bids. So in this example here, you know, I would pull the bids. We can see the resistance level on the chart here, and I wouldn't have that trade. You know, I wouldn't have entered the rest of that trade, you know, because the chances are you form something like a shooting star, a bearish engulfing pattern. You know, you could form anything. You could form, you know, anything like a tweezer top. It could be the start of a head and shoulders. Who knows? It could be anything on the chart. So make sure you have a little look at that one. The continuation one is one that I use a lot, guys, for breakouts, because the idea is when you break a level of momentum, generally will ensue on the chart. Now, I will make the slideshow available to anyone who wants it. Another optional one with this strategy, guys, is you can actually use the 10 EMA to filter direction. So in this example, we can see a market's ranging. As long as we're above that 10 EMA when the breakout occurs, it's actually okay to take the trade. If the breakout occurs and we're below the 10 EMA, which generally it shouldn't do that, then we obviously don't look to take the continuation trade. Okay, guys, so this is one of the methods that I use a heck of a lot, and you'll see it if you ever see me live trading in the room. I use it a lot, particularly after sort of data events. The other thing is the opening range. How many of you guys attended our market profile coaching when we talked about profiles and deltas and how we can use letters to identify market moves? Because one of the concepts we spoke about in that, guys, was about something called the initial balance, the opening range. And the opening range breakout is actually another one that can be used quite effectively. Okay, and in this example, we've got a little bit of gold on the chart. We'll have a look at sterling yen, because there's a good example of this in the market as well from today. Generally speaking, we can use the continuation or the opening breakout on anything above a 15-minute. Okay, I generally don't use it on a 5-minute, Adam. Just to answer your question, breakouts for me are sort of 30 minutes minimum for that sort of ease of being able to avoid white noise, when the market's to and fro. So opening range breakout, guys, another one that I use a lot. We'll have a look for an example of this on the chart in a second. Okay, basically when a market opens, and we can see gold here, okay, this opens after the weekend. We go from the 2nd to the 5th. Okay, we open on this blue candle. Okay, now the idea of this is we're looking at the first hour or first 2 hours of the trading day, because this is something called the initial balance, and the initial balance will generally tell you whether or not you're going to stay within a range or whether you're going to have a breakout. And the idea is very simple. If you have an initial balance of sort of an hour, the first hour of the trading day, and it's very, very narrow, okay, looking at gold here, knowing what we know, if we were to ignore all these candles that come after it, guys, would you say that range is likely to get broken in gold at some point? What would you say? Yeah, absolutely, because we know the average range of gold isn't, a few pips. It isn't $2. That average range in gold can be $20. It could be $100. Who knows? It's a very volatile market. So the idea is we are looking for the initial balance break, the opening range break. So very, very simple. We come to the chart. We look for the first 4 candles to form. We mark it up as a box. Okay, we mark the high and the low. And very, very simply, we wait for a candle to close above the high or below the low of the range. Now, that's how we enter into the trade. We enter on the open of the next candle. However, we only enter if, we are confident that, the market sentiment does warrant a continuation. However, the good thing about this is you can actually use it even against market, because even when a market is, moving up, potentially if we crash through this level here, there's a chance that it will just come off, even if it's 10 or 15 pips, okay, because it's to do with range continuation, and it's to do with the idea that, and let me just annotate the chart, it's to do with the idea that, markets don't stay in very, very tight ranges like this, We're not going to stay. That range is going to need some extension at some point, because we know that gold doesn't stay within the $2 range. So even if it goes against the trend, the idea is we break this trend, this sort of, support level. And the idea is if we begin to move down, yes, we want it to continue lower. But even if it just comes down enough for us to take advantage of a quick momentum trade, that's enough for us. We're happy with that. In this example, and let me just clear this. In this example, we can see that basically market opens, we break the 4 candle range that we have, we stay within it, and then bang, we have a break and we continue to move. Now, in terms of how you manage the trade, your stop loss is generally placed in 1 or 2 places, guys. You'll place it below the low of the range on the open. That's where I generally place it, just below the low of the opening range, because what you'll find is on some days, the market will actually form a shape like this. And basically what we'll see is we'll just see, trade take place within this range. Okay, it will just form a range. It will just range like this. Okay, on other days, you'll see the market will, start with a very narrow balance like this, where price is stuck within a very small range, and then price will just continue to trend. Now, on these days, obviously you want to minimize risk. So the chances are, if we break this level and then we break back into the range, we're wrong. We want to exit out of that trade. We don't want to take a loss. So generally, either below this sort of support level or this resistance level that may be support is okay. Now, in terms of managing the trade, sort of two ways you can do this. When you enter into the trade, okay, because it is a momentum trade and it's not necessarily a trade we're going to hold all day, one or two ways. As long as the accelerator, which we have on the chart here, continues to make a higher high, if we're above zero, so we see it go higher, 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 we'll hold the trade. As soon as it makes a lower low, or a lower high even, we will look to exit from that trade. So in this example, you can see perfectly on the close of this candle, the accelerator is actually a little bit lower, can't you? And it's red. Okay, so that tells us we would liquidate our position here. Okay, on the sort of more aggressive, the sort of longer term method, what you would actually look to do is you would wait until we break back below the zero. So in this example, we can see we enter into the trade, price moves up, we'd exit here in one example, but in the second one, we'd exit a little bit lower. Now, the advantage of this is sometimes the trend will continue in the direction and you will be able to take a greater reward. The advantage of this is you avoid the pullback if the market accelerator moves below zero, because we know that accelerator goes up and very, very quickly it retraces. So, being able to take advantage of the fact that the accelerator gravitates towards zero and away from zero during short intervals enables us to think about the momentum in the market and enables us to, take advantage. Does that make sense to everyone? This is a very, very common one for me, the opening range breakout. And it does help if you have a bit of sentiment. Like today, we know that the dollar's been weak sort of yesterday. So, potentially we would have had that long bias. Okay, so any questions so far, guys, on these particular techniques that we're using for breakouts? We actually have a little look at the chart, and we pop on top. I believe it's Sterling Yen had a pretty good example. Let's try and find it for us. So, let's have a little look to see here. 10 a.m., 10 a.m., 10 a.m., 2 a.m. So there you go, guys. We open around here. We're on a 30 minutes. So we open here, 4 candles form on the chart. As we can see, around here. So 1, 2, 3, 4. Support level comes into play. And again, we break the level here. We enter into the trade. Our stop loss goes above the high of those 4 candles, which is here. In fact, I apologize. We'd actually been in a long trade there. And then obviously it retraced. So, but you can still see, with that long trade, we had a 10 pip winner. Accelerator made a higher high, higher low, higher high. Then we moved back below zero. So actually, we'd have probably exited in this example around about here. And you know what? That's not an absolute disaster. We probably would have maybe lost a couple of pips. There is a good example from today, but I don't really want to move away from this because I've seen a very good breakout example that we're going to use in a second, guys. So have a little look at the opening one. It works well in commodities, guys, just so you're aware, any of you commodity traders out there. Another one, guys, a way that we can actually manage trade uses box breakout. How many of you have used a box breakout before? Any of you heard of this one? Similar to our opening range, but it can occur after a initial breakout has occurred. We're looking for a market consolidation. Okay, and with this particular method, it's very, very simple. You wait for a minimum of 8 candles to form. You move the sort of line as the 8 candles form. You're looking for the low point and you're looking for the high point. Now, you can do this for 10 candles. You can do this for 20 candles. It's entirely up to you. But I use an 8 candle range on a 30-minute chart. That's what I use. Okay, now, so we can see that we've seen a break of our level here on the chart, guys. Okay, now using the method, we enter into a little bit of a trade. There is a secondary support level. okay, we're looking to see if we can enter into a downtrend around this area here. Okay, and we form a little bit of a box. So we look for 8 candles to form. 1, 2, 3, 4, 5, 6, 7, 8. We can see the low of the 8 candles is this black line here, the high of this red line. And it's very, very simple, guys. Okay, we enter into the trade when this candle breaks. Okay, so we can see quite clearly we break on this candle here. Now, here's the thing. We do use an average true range. Okay, and the average true range you can see at this candle is actually 8 pips. Okay, and it's very important that the breakout must be between 50 and 100% of the ATR. Okay, so in this example, we can see the breakout actually from sort of the breakout level to the low itself comes in around double O. It's about 9 pips. We look at our ATR, it's around 8 pips. We've had at least a momentum. And the idea here is we want to try and avoid the false breakout where we just tick through and then we bounce. Because as we know, this level is lower than this level. These are all support areas, but unfortunately, we need to be careful that we're not just going to form another support zone and redraw that box. Okay, so very important that at least 1 times the ATR, okay, is seen. Okay, now, once you've got that breakout, okay, in order to manage the trade, your stop loss will go above your breakout level. Some people will use 1 times ATR again. Okay, so 8 pips, it would go above the breakout level. Others will just use a bit of discretion. If there is a support area, they'll pop it just above there to avoid being stopped out if we test it. And your profit target's very, very simple. You simply draw the box. So we can see that we've got 138.44 to 138.09. Okay, it's about a 35 pip box. And all you do is you will project the distance based on this consolidation. The other thing you can do if you are feeling a little bit adventurous, and it's something that we do in more advanced, is you can actually look at prior sort of breakouts and how far we actually move before we hit consolidation. So we can see that we have a range here. Okay, what some traders will do is they will look at the last 2 or 3 breakouts within a trend, even more, and they will look at the distance, the average distance that a breakout will travel, and they'll use the average to determine their profit target. Now, the disadvantage here is obviously the trend can continue, but the advantage here is if patterns emerge, if you find the market is generally, trending by sort of 40 or 50 pips and it's consolidating, even 60, 70 pips, okay, the idea is if it's done it sort of recently, there is a recency bias that it may do it again. When it gets to that level, traders will remember that it's gone that far and they'll be looking for a pullback. And then obviously, we pull back. And then when we break out again, you can enter again. And then if we break out again, you can look to enter again. Okay, guys, very, very important, the box breakout. In terms of other methods, we were asked about fake outs. How many of you guys actually trade fake out levels? Yeah, it's 8 candles minimum for me. But again, have a go. I know guys that use sort of 10 candles that I've taught this to. It is one of mine. This is sort of one of my adaptations of Darvis box theory, which is a stock strategy. But I use 8 candles. The reason I use 8 candles is it represents a significant part of the sort of trading session. You're looking at sort of a few hours on a half-hour chart. And it's enough for a consolidation or a reversal to occur. If we're going to move down and move back, generally, we'll see that happen quite, over those sort of 8 candles. Whereas if we begin to form a consolidation where market is sort of moving sideways, forming this little box, forming maybe a little bit of a bullish flag, we can see there, then, we can basically preempt that, potentially the trend is going to continue. But this has to be used in a trending market. I use an 8 candle rule regardless of the time frame, Dalesh. Give it a go though. Maybe the 4 hours, 4 on the 1 hour is something you can use. Generally, it will be 8 candles on the time frame used, and I use the 30-minute. So again, go away and have a little play with it. Right, guys. So moving on quickly, fake outs. Okay, very simple fake out strategy for you guys. How many of you actually trade a breakout but never actually trade the fake out when it sort of retraces? Do any of you actually look to trade both sides? Because it's a very, 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 very interesting one, the old fake out in the market. We can see we have a little bit of a resistance zone here. And again, we always mark the very top level of the resistance. The actual resistance zone on this chart sort of ranges from this area up to this area. But again, the breakout level is always the very, very high of the swing high, as we already know. And this one is for those of you who trade fake out or who like to trade fake outs. For me, just because we don't break through a level doesn't mean there's not a trade to be had, especially in a ranging market. Okay, generally this is very, very good in a ranging market, and it takes advantage of the fact that we never know how long a range is going to be lasting. We can see we're in a very, very big range here, guys. Okay, and it looks like potentially we could be breaking higher. There is a slight upward bias at the moment. Okay, but if we don't break that range, the chances are, guys, we could form another bottom, another support level. So I like to look to try and trade that, and to do that, is very, very simple. We take an ADX. Okay, and the ADX has to be, above an accepted average. And generally, anyone who knows me knows that I will use a minimum of the last sort of 20 to 100 candles, depending on the time frame that we use. It has to be above the accepted average. So if you pop to a chart and we just we'll put an ADX on here, guys. Okay, you can see that sort of the accepted high probably around that 39 at this point on the chart. We've peeked through there a few times, but generally we've had a couple of bounces. So, for me, you mark up the level. Again, you constantly amend it because markets are ever evolving. And there you go, we have like a 36. Okay. And generally what you're looking for is you're looking for the reversal to take place. And you're looking for it to maybe take place in a ranging market. That's generally when it's more effective. Okay, in a trend, you might just be forming a consolidation pattern. Okay, and as well as this, guys, we have a nice 50 moving average on the chart. And the reason we use the 50 moving average is because the 50 moving average, or maybe you want to use the 200 moving average, if we're trading close, price naturally in a range gravitates to this moving average, doesn't it? Whatever moving average we put on the chart, when we are ranging, it is obvious to see, here's a 50 EMA, that, in a ranging market, price will gravitate towards. Okay. And so we want to make sure that we're not in a trend. If we're miles and miles away from the moving average, say that we were, down here, for example, we know that at some point price is going to gravitate higher. Okay, so we want to be relatively close. We don't want to be on the moving average, but we want to be relatively close to the moving average, indicating that we're in a range, and we're still in a range. Potentially see a little bit of a pull away. What we do then is very, very simple. We look for some sort of rejection from the level. We can see we have a nice shooting star here, doji, and we look for volume. Okay, volume is a big, big, big confirmer. Volume should always be higher than the prior candle when we break out or when we have a false breakout. In this example, you can see sort of the volume I think it's this one here, guys. And is it higher than the prior two candles? Yes, it is. It's a lot higher than the prior two candles. We have a nice reversal pattern. We've closed below the resistance level. Okay, this indicates a fake out. Okay, again, volume, the easiest way to identify a fake out. Okay, now the ADX is very, very high, and when we're in a ranging market, the ADX will just move around a lot. And when it gets to sort of these levels, the idea is if we were to enter a trending market, the ADX generally will not pull away too far from its accepted average. Now, it will do that. This ADX could go to 60, 70, 80, whatever it wants to go to. But generally speaking, if the market conditions is a ranging market, or market conditions are saying we're ranging, if we get a rejection pattern with some volume, then you can sort of anticipate that this ADX needs to have a bit of a correction at some point and sort of tick back down. And then, obviously, if we enter into a downtrend, it might tick back up again. Okay, now in terms of how we enter, very simple again. I always use the open. The stop loss will go above the high of the either resistance level we've rejected, or if the price action pattern, so the shooting star is higher, we pop it above there. Again, discretion a few pips above is absolutely fine. And your profit target is generally set around the moving average. However, what a lot of people will do that I've taught is rather than just get out straight away at that moving average, they'll actually pop the profit target a bit further. And the idea there is if we sort of begin to spike back down and we see a very, very quick move lower, you don't want to hinder yourself by taking profit too soon. So, keep an eye on what the market is doing, have an optimal profit target in place. And then if we get down to this level and, we fail to close above the move, below the moving average, maybe we get a hammer or something like we see here, a hammer pattern, then you can always look to exit the trade. And again, using a little bit of discretion, very, very important, guys. So this is the moving average. And in terms of the main tool I use to avoid breakouts, Dilesh, it's on the next slide. Okay, volume. Volume is important. Okay, for me, avoiding fakeouts, volume is key. And what I mean by that is when we break a level, we need to see a higher volume. And generally, you want to see a volume somewhere in the region between 10 and 50% higher than the prior candle. In this one, we're over 100%. Okay, volume is crucial. Okay, because how can you trust a move lower or a move higher if your volume, and this is a fairly recent example, guys, from March, I made this about a month ago, this presentation, and it's, was an example that I took. If volume is much, much, much lower, or if it's around the average, you can't really trust a breakout because it will indicate the market is generally low on liquidity. Another thing, breakouts are less likely to happen outside of market hours because banks are not at their desks. So you need to look at the sort of time of day. Breakouts are more likely to happen, as I say, in the early part of trading or around midday, 1 o'clock. So all these things can help you indicate, when a breakout could potentially occur. They can occur at any point, but volume, time of day, things like that are important. Right, guys, I've been told we do have to wrap up just before the end. We do have one more slide. It is the inside candle, guys. Basically, if you do get a breakout of a level and there's an inside candle, generally it's a reversal signal because there's no momentum in the market. Now, we do have to wrap up, unfortunately. I do apologize about the power outage, but I will make this slideshow available to anyone that is interested. My email is jack.inman@trademo.com. And I'd like to thank, obviously, you all for your patience. So make sure you get the slideshow because there are some interesting points on there. And if you have any questions, feel free to email me. And I do apologise, guys, for the technical issue. Good old Gibraltar at its finest, I'm afraid to say. Right, guys, thank you for your participation and your patience. Next time it will not happen because I will have a backup generator installed under my desk just for this computer on its own. Thanks a lot for tuning in, guys. I hope you have a pleasant afternoon. Have a very, very good trading day, guys. Bye-bye.